What's up, everyone? Welcome to the 301 Club, where we teach you how to buy real estate in your 20s. Like and subscribe. Hope everyone had a good weekend.
Yes, sir.
Today we talk digesting information because at this point, you've done a lot of research and a lot of work. You've walked around a lot, and it's time to relieve your body and do some meditating if you need to. So we'll take this moment to talk about making sure that you get your sleep and you do your breaths. Breathe in, breathe out, and this will help you to continue with your research goals, because probably at this point there's a lot of information and a lot of words that might be not that easy to understand. And so the best way to approach this, something that I did, is I took a book out of the library. This is a free option, right? And I took out a book called Nolo's Essential Guide to Buying Your First Home by Bray Ilona. And it was a great book because it separated each subject. For example, at this point, once you're ready to put an offer on a house, there's going to be a lot of things that you need to, obstacles you're going to need to cross, and a lot of people that you're going to need to talk to and have on your team, right? It's kind of like a football team. So this book basically goes into each player's priority and purpose as being a part of your team. And there's various people that are going to be on your team. For example, the tiling company, your realtor.
Yep.
At this point, you have a realtor.
Yeah.
So the book will really help you get prepared to have conversations with people that you're going to meet later and beyond taking the offer down, which might include the seller. What other obstacles did we come across, John?
When it comes to like finding agents and whatnot and stuff like that. I mean, just in general, sourcing loan officer and agent, finding a mentor, finding different experts in different industries. When it comes to buying a house, of course, you need to know, what agent you're working with. You need to have a loan officer, which, you take the time to find one. So stuff like that is very important. I believe, we learned from the beginning that we should try to, talk to as many, I guess, loan officers and get as many pre-approvals and, taking the right steps and doing those things. And you can go into, I guess, the mentor you had earlier on.
Yeah, for sure. So, and then when it comes to talking to all these people, YouTube is a great platform to research specific problems, these obstacles we're talking about, and industry terms. And on today's episode, we're going to go over some obstacles that we had confronted and the ways that we got around them. So first of all, you can have a conversation with someone you trust, and that can be a family member or a mentor. It depends what kind of knowledge you're trying to get from them. It's good to talk to your family member because you could have a good conversation, de-stress, talk about how their experience was with buying a house if your parents have bought a house, or if you know someone who's bought a house. This is a great time to get their experience at this stage, which is when you're putting the offer down. Right. But before you put the offer down, you might want to talk to a mentor. And this is something that I had discovered as I went to the Lee Arnold conference in Coeur d'Alene, Idaho. Shout out 83815. And basically, he recommended all of the different ways to approach at looking at how to buy your house, and maybe he also gave some advice on things that you wouldn't expect to know being a first-time home buyer, because he's experienced this before. And experience and wisdom is something that is really going to be helpful to you at this point as you're digesting the information. And not only do you need to talk with your mentor about, or just at this stage in the process, but they're going to be useful a lot more down the line. And that brings us to talking with your agent, because building a friendship is very important with that agent, and understanding
definitely
each other's goals of what you're trying to get out of this.
Yeah, I think that's important. Also, sometimes if you get lucky, the agent has personal experience and they have their own background, and that's where our agent came in, and the one we ended up choosing. It was funny enough that he was in the real estate industry as well, not just like as an agent, but also as like an investor. And he had one property, and he also told us that he had somebody in his well, in his agency that was his like mentor, I guess, or kind of like his boss. And then he had 4 properties at the age of 25. So just sourcing experts that, or having people around you like that you can reach out and ask for, guidance. And that's kind of what we did with our agent. He gave us a little bit of like that reassurance that it is possible to do what we're talking about, which was, seasoning, I guess is what it's called. And we talked about that in the earlier episodes. And so, yeah, that's something that we we sourced that information from him, confirmed, and we, kept that ball rolling.
Yeah, we've chose a strategy and we stuck with it. And at this point, we digested all of the industry experts' knowledge. And there was one instance with Betty.
Yeah, so like the banker, that was like where we got the initial information of how we should move. And so that kind of like, we took that and kept that rolling. And, we realized that that was probably the best option and the best way to move in the industry. And so that's what we ended up talking to the agent about. And he had his own personal experience and he was open to be like, have a conversation. And we sat down with him. I know we talked about in the earlier episodes as well that, we sat down at the smoothie spot and we had a conversation about it. And he like confirmed, yeah, that's how you should do it. And, you're doing the right things and don't overwhelm yourself and this, that, and third. So I think that's...
Don't overextend your budget. Don't get shop happy, etc.
Yeah, and stuff like that. So, I think that's like that's all very important. And if anybody wants to know more about that, they can leave a comment below. But yeah, that's, I think, important for sure when it comes to having all that information at hand and, you use that information and make the next steps or keep the ball rolling.
Right. And, you can get information from industry experts, which is definitely a priority. The second on the list would be even having a conversation with yourself at this point, knowing your worth and what the market looks like and the economics of where you're buying, to understand that there are different aspects that build the equation to what your actual loan is going to cost in your monthly payment. And so this is where you got to ask yourself, what is most important to you right now, and align it with your strategy. For example, John and I decided to do a house hack. So we were going to buy a 3-bedroom, use one of the rooms for renting or a podcast room, and also add extra to the principal every month. Because what happens in your principal is the amount that you owe back to the bank, not including the interest or escrow. And escrow is a collection of all your taxes that the bank will pay for you automatically or by your choice. But
right. I wanted to throw in there if I can. I think there's a misconception, or maybe a lot of people don't know this, but when you pay your mortgage, you're not really the 1,000 or so or whatever it is, whatever your mortgage is, maybe like 10% of that goes to actual principal balance. So you're literally paying like 80 to 90% in interest. So realistically speaking, it's like kind of like, set up in a way that it'll take you 30 years or whatever, because that's like the minimum, I think, 30-year mortgage loan. But so it's better to make sure and this is something that we can get into in the future as well, or if they have any questions, we can clarify it. But the prepayment penalty, to make sure that your loan doesn't have a prepayment penalty, because if it does, you can't pay more than what the mortgage is per month. So if it doesn't have the penalty, then you're more than welcome to pay more. So let's say you pay the $2,000, that's your mortgage, right? You end up paying $3,000 because you want to put a little more towards the principal. So that difference, that $1,000 difference from the $2,000 to the $3,000 goes straight to the principal. And so that's kind of a way you can house hack. And so that's something that I think people should consider. And they should do that. And so I think that's like a good move.
Yeah, for sure. And like that's just an example of how we had it done and how it aligned with our principal plan. But at the end of the day, you could have your own situation in case of the economic situations of what's going on. For example, if your strength is the fact that the interest rate is really low, then you might have lived in a time period called 2020. But during our period of buying a house, the interest rate was being lifted 0.75 basis points pretty much at least once a month at this point. And actually, the week after we got pre-approved, the basis points went up, which affected our interest rate. But for us, we knew that we were going to refinance in a year. And refinance is when you get a new interest rate with the same or a new bank, so that you can pay off the loan through them. And that what we know about that is that you can do this after 1 year time, which is the seasoning that John mentioned. And so that was our plan. But again, if that's because we had capital on hand, an excess amount of capital on hand then maybe your worth comes down to what kind of down payment you can put into this or closing costs.
Yeah, so understanding that you have money that needs to, like, you need to have a certain amount of money to get a house. Of course, that's a given, but there's also that extra 2 to 3% of what the house is worth for closing costs. So not only do you need a down payment, let's say you get lucky, you get a 3 to 4% down payment on your loan, and that's what they're requesting. You also have to keep in consideration that 2 to 3% of closing costs that's added on top. So realistically, double what you're, to keep a good, like, an idea of what you're working with. Good idea is to double whatever your down payment is, and that's probably what it'll end up being for your closing costs. It's not always like that, but have enough capital where you can afford to pay those closing costs. Because for us, it was about double from what we were trying to put down. I think we were trying to, what you were putting down essentially. Not necessarily me, but yeah, because I know you took care of that, and you can get into that now if you want to explain your your sources of income.
If there's a case in which you get an inheritance or a large sum of capital, then this is going to go to the side of your worth, and this is what you can take to the bank. And when you start researching other banks in the area, you know that you have the capital secure, and at this point, it's going to be more negotiating the interest rate. And the way that can be done is you just have to go to other banks. And we can talk about our situation, how it happened. At first, we had no differentiation in our minds between a local bank or a national bigger bank.
Right.
So at first, we looked at PNC, which is a pretty national big bank, Northeast area. And they gave us a good interest rate. But however, we realized that there's other interest rates that we could get from other banks. So what we did is we actually went to a bank called Truist. Unfortunately, they didn't have a loan officer on the premise, but they had a bank teller who gave us a number to call. And unfortunately, we just didn't.
I guess because we were just not time. I guess for us, we were kind of moving fast, so we didn't end up returning their call, or you didn't return that that call. But I think we ended up walking across the street, and then we went to this other bank.
To me, it was like kind of a red flag that they're not going to move as quick as us, and that's something that after we ran across the street,
went to West Banco.
We went to West Banco, which we realized is a little smaller, localized little bank, and they gave us really
they're national,
good rate,
I think, but they're just
really
not
good service.
As big as like Bank of America or stuff like that.
Exactly. They're not as big as these other banks, and that's something that we didn't even end up going to. Is we didn't go to Bank of America because of our time limits, and we knew that bigger banks take a longer time to close your loan.
Right.
Could be up to 45 days, when we needed it done in 21 days. So shout out to West Banco for that.
Yeah, exactly. I think Bank of America right now, the only benefit that I've heard about was that that benefit where they're giving out no down payment, low interest rate loans that's happening in certain areas. I think like LA and Miami and other areas. But that's something that we just didn't get a chance to like check in with Bank of America and get that pre-approval and check all that stuff. But I know we did go to other banks.
Yeah, just to interject, another thing you can get a part of bigger banks is grants. But these grants may not be guaranteed, so just be careful and make sure you get everything in writing.
Yeah, and there's a difference between grants and loans. So sometimes they'll offer grants or loans, and preferably always go for the grants because you don't have to pay those back. And if you get like a loan, we have in Maryland a loan called MMP loan, and that's like an assistance loan for like down payment and closing costs. But that money is due once you either refinance or you pay back the whole
or sell
mortgage. Mm-hmm. Or sell.
So it's a loan you have to pay back. It's not a grant.
And it's paid back in full. So if it's $5,000, you're gonna have to pay that $5,000 immediately. You don't get a chance to like pay it monthly. They don't do stuff like that, I don't think. I mean, there may be, but as far as what we know, I don't think that's a thing. But yeah, that's what she said. It's a lump sum payment that's due after you refinance and etc.
Yeah, and as far as our strategy was concerned, that wasn't a good part of our equation to give us our worth, because
we're gonna refinance.
Yeah,
or
at the end of the day, we know
as possible.
Right, and that way we didn't have to worry about the interest rate too much, and it gave us a lot of leverage once we knew that we were gonna be able to refinance in a year. So a part of being able to refinance includes your credit, though. So
yeah, and I think we heard a bunch of things. We heard 3 different things from different people. We would say like stick with a 30-day limit, but there is this misconception that people will say, like, because we met that banker at West Banco, and she was I think a branch manager, and she said that I believe she said that she thought that every pre-approval you do, your credit gets hit. So that was wrong, obviously, because we learned later on, and I have a loan officer friend. Later on, they told us that where I was told from my loan officer friend that that wasn't the case, and that you had at least a 30-day limit. I know in certain areas it's different, so I would check in with that and do your research in your area, see what it is. But I think it's a 30-day limit is the minimum. So you have 30 days from the first time you do a pre-approval and they run your credit. So you get as many pre-approvals. Don't be afraid to, because I think there is that misconception where maybe I'll just do one or two. I don't want my credit to be hit too many times. That's not the case. You have 30 days till you do as many as you need. We did a few. We did West Banco. We did, or you did, you know what I mean? You
PNC, Navy Federal.
You went into, yeah, we did PNC.
We did a credit union. That's a recommendation right there too. Try a credit union. They didn't give us the best interest rate, but they gave us the second best interest rate,
right?
Which we were able to
use
to
you
leverage.
Leveraged that with on the other one on West Banco. So yeah, so rule of three: make sure you have at least 3 banks that you're working with, and then you leverage that in best way possible, and you don't be afraid to let them know you're working with other banks and you're trying to get the best rate. So yeah, I think that's kind of what that goes into the next thing. I guess what we're talking about when it comes to
being on the title. So at this point, after you've digested all this information and you've compared offers, you've probably gotten callbacks from the loan officers saying, "Oh, we'll lower your interest rate if that's what you're looking for," or "Oh, hey, we can cover this closing cost." That's going to be a negotiation up to you, right? Another thing that you're going to have a conversation with yourself about, and potentially someone else, is if you
like
buy
I was
the
going to
house
throw in there, like if you have a spouse and you have you're a couple and you're doing this, also understand that sometimes if you get a joint loan, it's worse than getting it's worse than getting a single loan for that one singular. So let's say like the one specific person in the couple makes more, right? And his DTI is actually lower. And so if his DTI is lower than your combined DTI, which is debt to income ratio, then it's better to just get the single person or the one person to do the loan and put their name on it and run it that way. And so I think there's that to keep in mind, that sometimes it's better to, evaluate everything, and make sure that all that, you do your due diligence, and, you test both things. You test both options where, one versus the other, which one's better.
Yeah. Long story short, you can have one borrower and 2 people on the deed.
Yeah. So for situations like that, for a couple, let's say the one person takes the loan out, but like you guys are they're married, right? So then, if they're married and the one person has a loan, they can still put the other person on the title. And there's other forms of options for titles. There's a few, and I think I was supposed to go into that, and I did leave that paper downstairs. But all right, awesome. So I'm here back with the paper that I was supposed to get from downstairs. This is like in regards to titles and the title and ownership and whatnot. So I know I had mentioned that for certain situations, like let's say you have you're in a relationship, or you're married and whatnot. Excuse me. There is different types of ownerships, and I'll go through them real quick. I'll list them off. So sole ownership, tenancy by the entireties, tenancy in common, joint tenancy, and I believe that is it. And then there's also like a few more: community property, tenancy, and severalty, something like that.
Yeah, the ones that
those are like
make the most sense, or the ones that are easiest pronounced. And these are going to be the ones that you're actually going to want to focus on.
So I think the ones that we were more interested in is joint tenancy and tenancy in common. I think the joint tenancy is kind of where it's at, I think, for the most part. And I think that's what most people do, especially if there's 2 people involved. And so, and that, I think that's like the best way to go if you have more than one person involved in the purchasing of a house, or just in general. If they're, if it's a spouse or whatnot, the one person takes on the loan, at least, you can still have that opportunity to put your spouse on the title or the deed, So that's good. Keep those things in mind, and not only does that help with like the process, it also, if you have 2 people living in the same house, and, so that's like a good idea, just to like make sure you take care of all those things and, work with the other person. Or if it's by yourself, obviously you don't have to like really put much effort into this. You would just pick sole ownership. If you're just by yourself, that's all you really need to worry about. But this is more for people out there that have another person that they're working with. It may be your wife, whatever, significant other, whatever it may be.
Yeah, and we mentioned like specifically having one borrower and 2 people on the deed, and the reason for this is that it's a financial incentive, because this means that you can buy one house with the first-time home buyer incentives. For example, FHA, like John mentioned, MMP, that's a Maryland mortgage payment program, and then grants, or you can change your down payment down to 3%. you don't have to pay 20% on a home loan, and this really depends on if you're using the Home Possible or the Home Ready loan, these are all first-time home buyer programs. And the list goes on and on. So there's a huge incentive to have one borrower and two people on the deed if you want to build financial wealth for the future.
Yeah, exactly. I think those things are important.
Yeah, so I think that wraps up this episode. We got some links in the we got some links below for the resources.
Yeah, you had it right. It's
for everything up to this stage in the process, and so check them out. You're gonna find some budgeting sheets and some links to help you with your negotiating skills, etc. So
yeah, so
thanks
I guess
for tuning in.
Yep.
See you next time.
See ya, guys.